everybody. We are into day 3. Thanks, Herwig, for kicking it off yet again with another amazing day lined up. We've got more industry leaders, more Q&As, more panels. Leave all of your thoughts, comments, and suggestions in the comments wherever you're watching this. We do have participants here on the Zoom client, as well as shout out to all of our YouTube watchers. We've had hundreds of people tuning in to the YouTube live streams each day, which is very exciting, cool to see. And so today I want to kick off our morning episode talking a little bit about the basics, because as I talked about in my panel yesterday, or certainly the day prior, sometimes everybody getting on the same page around the jargon, around some of these more fundamental concepts of the technology and of capital markets is so important in order to actually make progress in this industry. And so we believe this so firmly here at Security Token Market that we actually wrote a book on it. So as Herwig talked about, and as we've talked about here on the show, over the podcast that we do for over 4 years now, a new show called the Security Token Show. We now have the conference here. We've talked about Blockchain Explained, now a bestseller on Amazon, thanks to the hundreds of people that have purchased this book. The goal here is for us to create academic content that we can use to teach in universities. We can send to clients. We can have people that are interested in learning the real fundamentals behind the technology and understanding what's actually going on. And I can start with a personal anecdote. I got involved in the crypto space back in 2013, mostly as a speculator, as an investor looking to participate in the technology. But I had another side of the industry that I was passionate about, the underlying technological components, specifically around consensus mechanisms for the actual blockchains themselves. But most of that kind of gets washed down the road because of the fact that everybody's focused on the financial opportunity of the speculation. That's what has happened over nearly a decade since that time. It feels like people only really care about blockchain technology when Bitcoin's price is nearing an all-time high, when you have access to speculative investment opportunities like the ICO and crypto craze back in 2017 that carried well through into 2021. You also had the NFT craze around purchasing art and having access to communities and seeing how that had its own bubble. And so there are all of these more retail-driven speculative investments, and that's where so much of the hype of this industry comes from, because the technology empowers liquidity. It empowers you to be able to convert these less than liquid assets into real dollars very efficiently. But the value that comes from the technology and the value that we talk about in this book has nothing to do with speculation. Really, what we're talking about here is what the technology can do to empower capital markets. So first off, when we're talking about blockchains, really the problem we're trying to solve with blockchains, in my personal opinion, is actually automating a lot of traditional financial mechanics. So when you have a capital origination event, now let's talk about what that even means. When you have a situation where a company is looking to fundraise, they are taking their product, they are the issuer, right? The company is called the issuer. They are taking their product and they are issuing stock or investment into, or assets in exchange for investment. So they're giving an investor something, whether that means equity in their company, whether that means a debt style of structure in which they are giving essentially a loan, whether you have an interest rate, whether that could convert into stock at a later date, all types of structures. You have a capital origination event. The event is where that capital injection occurs. You have an investor giving money into a business. You have a business giving stock or a debt style of note to the investor. That is your capital origination event. That process is very manual from both sides. You have the investor having to get the money into the company. And so that alone, the payments technology behind that is something that can be drastically improved. If you've ever sent a wire even domestically, let's say here in the United States, it could take 3 to 5 days to do an ACH transfer. If you've ever sent an international wire, we step the level up one level. It can take weeks potentially in order to get that passed through. And then certainly if you are a qualified institutional buyer, you are a high institution with a significant amount of capital underlying, you're trying to move 7, 8, 9 figures of capital from one institution to another. It can take months in order to facilitate that process. Some of that is, justified. You need to do the compliance. You need to make sure, are the two parties involved in this transaction really who they say they are? But there's a lot of underlying infrastructure that makes that happen that is incredibly, let's just say, outdated. You may have investment banks that take tens, hundreds, or thousands of individuals who are basically just copying Excel sheet numbers from one side to another in order to validate the different components, especially when you're talking about scale of transactions. One transaction for $100 million might not have the compounding effects of tens of thousands, millions of smaller transactions adding up to the billions or trillions of dollars of transactions that financial institutions do on a monthly or yearly basis. So a lot of these institutions have to have significant manpower and operational expenses just to validate and justify a lot of the business practices that we take for granted as the buy side, as the end customer. When I go to Robinhood and click buy on GameStop stock, I don't see all of the work that goes into it, but yet you can feel the impacts. In the GameStop example, one of the significant problems that led to that crazy historic and meteoric price rise was the problem of the fact that a lot of the underlying institutions that were in charge of maintaining the record of ownership lost the location of a lot of these shares. This is a situation where they didn't know who owned what and where those stock was. And so basically what ends up happening is, and certainly in that case, there was actually over 100% of the stock that was shorted. This is a great example of manual oversight, just being inefficient compared to a technological infrastructure where you could never have a over 100% of the outstanding float being shorted, because in order to make a shorting contract, we could enforce that there needed to be both parties with local and located assets. So that's a great kind of analogy for a lot of the traditional financial infrastructure that sometimes can go wrong. So where does blockchain come into this component? Well, in order to automate a lot of these financial systems, we need to be really, really 100% certain that the information we're using is correct and it is proper. We need to track that over a period of time. Consider the provenance of that information, of that asset. You need to start at origination, as we mentioned, at that capital origination event, when that asset is structured for the first time, when the capital enters into that vehicle for the first time. We are essentially starting the big bang with respect to that asset and then going over the life cycle of an asset. We need to have each and every thing that happens throughout the life cycle of that asset needs to be recorded in a ledger or on a database that we can trust cannot be edited, cannot be changed, is the unequivocal source of truth, and is one that can be accessible by all parties that are privy to this transaction. That includes the investor originally. That includes the issuer taking on the capital. That may include intermediaries throughout the process, including a transfer agent, a broker or syndicate network that may be working with this asset, an underwriter and other financial services providers, legal counsel, regulators, governing committees. All of these different individuals may need access to this information, and we need to be sure that that is proper, it is buttoned up, and it's very tight. So that is where blockchain provides key benefits, because once we can take that information and be sure that we know what's going on, we're sure that it is legitimate, and we are sure that it is effective, we can then automate a lot of the processes that traditionally we had to have human oversight every step of the way. In fact, a lot of the bloat and potential bureaucracy of this process is really just to safeguard the potential opportunities for failure, right? The more checks that you put in throughout the process, the higher likelihood that somebody might catch some of the problems that goes on. Not to mention that there are potential opportunities for incentives to delay this process. We see all the time that institutions are able to capitalize on float. When we talk about float, we're talking about the amount of money that is floating kind of in this void area where, okay, if I'm sending $100 million wire from one financial institution to another, and it takes 2 weeks for that process to be completed. Well, inside of that 2 weeks, one of the institutions, probably the first one, may still hold that money in a bank account while they're trying to work through a lot of the compliance and all of the details in connecting to the second bank. So over that period of time, they may be able to actually use that capital for short-term opportunities to make money off of that money that should be at another bank, but isn't due to a lot of the structures in place. This is where we talk about the increasing or the reduction, really, of settlement times, for example. When you see something as T+2, or in the panel that I had last week, we were talking about T+55. 55 days after a transaction happens is the average time that a lot of these back office transactions are settled. In that period of time, someone has the asset when it should be with someone else. So if they have the asset, someone else doesn't have it when they should, that first party may not be incredibly incentivized to send it faster, to improve this process, because they are actually potentially capitalizing on the fact that someone else is delayed. So this removes a lot of those perverse incentives when you can automate a lot of these components. When you can speed a lot of this stuff up, you can make sure that all of the compliance checks get taken care of prior to the transaction, and you can assume that all these things move forward quicker and are settled faster. So this all culminates in the idea of the real benefits of blockchain. When we're talking about what blockchain does for capital markets, it really boils down to two things. If you're a financial institution, what is your main job? Essentially, to make money. So there are two ways that blockchain can assist with that. Either in reducing costs, which in the greater context of financial and capital markets, we might consider that reduction of the cost of capital, right? So what is the cost that it costs you to acquire capital for your clients? Well, if we can reduce what that cost is, whether in actual manpower and reducing the operational expenses of your business, or in speed in terms of reducing the amount of time that it takes to get that capital, both of those are costs. So reducing the cost of capital, or we have increasing the yield, increasing the ROI, increasing the IRR, the APY, these types of figures or statistics that we use to measure what is the end return. So they kind of go hand in hand. If you can reduce the costs, then it makes the rate of return higher because you're maybe making the same amount of return with a lower cost. That means that you end up with a higher profit. But potentially with automation, instead of just reducing our cost of capital, we also can increase our output. We can deliver more originations. We can create more opportunities for reinvestment because our settlement time is cut in half or cut in a third or reduced by 75%. We can then increase the amount of transactions we're doing as an institution, which then increases the top line revenue as well as reducing the costs. So there are kind of two opportunities that blockchain can reduce the cost of an institution's back office, as well as improving the client-based services and increasing the top line revenue. Both have potential opportunities, and we've actually seen both happening in the market. We've covered a lot of it throughout the event in this panel, but so much of it is detailed here in Blockchain Explained. So Blockchain Explained, I'm just going to talk through what the table of contents is here just for anybody that's interested. We start off talking about the blockchain fundamentals. So this is the important part of what the actual technology is doing. I think a lot of people may not actually know what's going on. We use graphics, we use imagery, we explain what's going on with Bitcoin, with Ethereum, with proof of stake, proof of work, a lot of the underlying fundamental concepts of blockchain. If you're a financial institution, is this going to be crucial for your business model? Probably not, but it is important context. That's why we lead off with it, because this is what everybody's been talking about for a decade. And you may as well at least have a decent idea of what's going on so that you can sort through some of the hype, some of the jargon, and some of the BS, if we're being completely honest. Moving in, then we cover what everybody traditionally knows about cryptocurrencies and utility tokens, talking about decentralized finance, a lot of the components that are mainstream with respect to this stuff, but especially with decentralized finance, are potentially incredibly innovative, talking about what solutions we can have to automated market making, for example, which perhaps is one of the biggest innovations of DeFi, or collateralization, taking illiquid assets and being able to get a line of credit collateral on it that's funded by the community, as opposed to having to go to an investment bank. Then we talk about stable coins and CBDCs, which I believe might be the killer app of blockchain and cryptocurrency from this initial 10-year period. Is we've seen payments technology revolutionized. How can we take tokenized deposits and transition that into a payment infrastructure for capital markets, whether it's from a transactional perspective, from a buying and selling of shares using the stablecoin, or from a capital injection and investment perspective, as we talk about with tokenized dollars and debt instruments. Certainly CBDCs, central bank digital currencies, are different than stablecoins. Oftentimes, stablecoins seem to be coming from private companies versus CBDCs, or government-sanctioned central bank digital currencies. They are very different in terms of how they function, of their oversight, of their governance rules, all those different components. We have yet to see a CBDC reach the same level of market cap and market size as some of the leading stablecoins like Tether, like USDC from Circle, and others. Then we go into the real meat of the book. This is talking about commercial solutions, security tokens, and everything to do with the technology behind capital markets infrastructure. Here at Security Token Market, we have spent 5+ years talking about securities, equities, real estate, debt, all of the real exciting assets that have real value in the real world. How can we take those assets and apply tokenization technology for fractionalization to allow for anyone, anywhere around the world to invest and participate in these markets, to build healthy secondary platforms and post-issuance services like the collateralization and automated market making and other tools pioneered by DeFi? We can do a lot of those things technologically with securities. There are certainly compliance components that we need to adjust for and account for with respect to a lot of these things, but the roadmap is there. Then, to close out our book, in the final third of the book, we talk about decentralized autonomous organizations and how governance can be transformed by leveraging the newer technologies, by employing and empowering shareholders in a much more effective way than what we see in the traditional markets. We dive into NFTs, talking about what they actually are. Hint, hint, NFTs, really, that's just a quality to define an asset. Is it fungible or non-fungible? Certainly, there is a whole community and industry around art and graphics and all these types of things, but NFTs are actually much simpler than that. And any financial asset could, in theory, be an NFT. We talk about all of that in the book. And we close it out with regulations, how private fundraising exemptions work, what is going on. This is, of course, not legal or financial advice, but it is our perspective over years of working in the industry. And then we talk about digital asset hybrids. This is what I mentioned with the fact that anything could be an NFT. So you could, in theory, have a security token NFT. It's a non-fungible share of a security, or vice versa. You can do a whole lot of things. You could have a utility that's tied to a security. There are all types of hybrid opportunities that we can see in the future. And then we talk about the outlook and trends for the future. And then finally, of course, at the end of our book, we do define every single term throughout the entire book. So this really does represent a textbook with respect to your blockchain 101. I've been fortunate enough to speak at the University of Miami, at Florida International University, and I've talked at universities across the country about the technology. This is the #1 resource for investors, for bankers, for financiers, for entrepreneurs, for artists and creatives, for academics, for students, for anyone to learn and truly understand in a clear and concise way everything that's gone on in the industry. I guarantee you, if you read this book, you will be fully up to date on what's going on in the industry with respect to the actual components, the building blocks of these technologies. With this, you can then build on top of that with all of the companies, with all of the innovative mechanics. We don't cover every company in this book. We never could. We talk about the technology, the components, the fundamentals, so that if you read this, you have all of the tools in your toolbox to be able to take this industry by storm and revolutionize your business or industry by understanding what's going on in blockchain, both with respect to the opportunities, but also with the opportunity to ignore the hype, to see through some of the jargon, and to really be an expert in the industry. So that is Blockchain Explained. I'm lucky to be an author alongside Herwig Konings and Peter Gaffney as my co-authors. Fortunately, Mark Powers, our former SEC attorney and advisor, who is also a university professor at the FIU Law School, gave us an amazing foreword to start the book. We also have a few unbelievable quotes from Anthony Basile from Coinbase. We have Anthony Mora from Provenance Blockchain Foundation, of course, and also Patrick Mira from Invenium, all giving us amazing quotes here on the back. So major shout out to everybody who supported us with respect to this book. We did hit the #1 bestseller in the business law category on Amazon, as well as hitting #2 in finance and banks and banking. So we certainly, I think, hit the categories we were looking to service, and it was great to see such a positive reception. We've gotten so many 5-star reviews for the book. I've sent so many copies to clients, friends, and family, and we really, really appreciate everybody that supported us along the way. If you want to get this book, you can get it on Amazon. You can get the Kindle version. You can get the paperback version like you have here, or there is a exclusive hardcover option as well if you want the full Monty there. And reach out to any of us with any questions you have. Thanks again for everybody for tuning in to the Tokenize This conference. And we are going to get ready for our next panel, which is going to be amazing. We have a whole slate of amazing things coming up this week. So with that, I'm going to leave you, and we'll talk to you in just a couple of minutes. Thanks a lot.